Welcome to episode 34 of the Cashflow Connections podcast. The topic for today is investing in restaurant real estate with Kevin Burk of Trinity Capital. This is a topic we haven't yet discussed on the program, but I think it's important to talk about because there's some really interesting changes taking place in the market for a variety of reasons. The restaurant business is typically thought of as a high-risk, low-profit margin business, but I get the impression from this discussion that a lot of the risks associated with the asset class are significantly mitigated when you invest in some of the top 100 or top 50 brands in the US, which is our guest's general strategy. Today, we're going to get into the details of restaurant real estate and find out where the opportunity currently exists in the space, what the four main sectors are within the restaurant business, and which one of those sectors are most recession resistant, which I think is really important. We're also going to talk about technology and how technological advances may impact the restaurant business as a whole. And then also the Amazon threat. This is something a lot of people have been talking about in the industry, which is obviously Amazon has an incredible distribution capacity. They also recently bought Whole Foods. So how is this really going to impact the sector as a whole? And then how are the preferences of millennials shifting the restaurant business, and what impact might this have? So obviously, we're going to discuss a lot of topics today. Definitely should make for an interesting conversation. I'm really looking forward to your feedback on this episode. Now, before we get to the episode, just a reminder, if you haven't yet signed up for an account with Cashflow Connections, make sure to go to cashflowconnections.com, create an account, and sign up as an accredited investor. We have a consistent amount of deal flow when it comes to recession-resistant assets, most notably mobile home parks and self-storage. So if you're interested in diversifying into those niche, weird real estate investments, we can help you out. So go to cashflowconnections.com, sign up, get an account, and we'd be happy to get you cash flowing immediately. All right, hope you enjoy the episode. How's it going, everyone? Today we are joined by Kevin Burk, who is the founder and managing partner of Trinity Capital, which is a private investment banking firm that has completed more than $20 billion in mergers and acquisitions. Kevin is a regular speaker on a variety of different topics, including the restaurant industry, franchising, as well as the economy. His restaurant expertise and knowledge makes him and his firm a go-to source for many prominent firms that consult with the restaurant industry's business leaders. Trinity has an extensive list of high-level clients, including Bain Capital, Goldman Sachs Private Capital, the Carlyle Group, and many more. So obviously, we're going to discuss some topics today, which we haven't discussed previously on the program. So I'm really excited about this one. Kevin, thanks again for coming on.
Thank you, Hunter.
So before we jump into the topics for the day, which have a lot to do with the restaurant business, let's talk about a little bit about your background. How did you get started? How did you end up founding Trinity in the first place?
Well, I'd had a career on Wall Street with Dillon Reed, LF Rothschild, Unterberg Tobin, and Prudential Securities. And I moved out to Los Angeles and worked for a boutique firm for a year or so. And then I got a crazy idea to start a company that would be backed by asset-backed security groups on Wall Street and would make loans to initially gas stations, which nobody wanted to lend money to in those days, and then secondarily we got into restaurants. And the idea was that in those days you could only borrow against real estate or a personal guarantee, and the banks were very, very skittish because of the high failure rate in global restaurants. But what we were doing is working exclusively with chains. And there's a lot of mom and pop restaurants that are not good credits, and the restaurant failure rate in the standard industrial classification codes, if you will, the failure rate is very, very high, and it would scare off any banker. But we looked at the top 100 chains and discovered the failure rate was considerably less than 1%, and so we came along with collateralized mortgage obligation style financing, CMO financing, and it caught on like wildfire. And the first year I think we financed around 100 million, and within 3 years we were at a run rate of $1.5 billion.
Wow, that's incredible. So just to be clear, you were providing the financing for people who wanted to franchise or create their own restaurants as long as they were within that chain model?
That's right. And we looked at organizations that were not single unit, borrowers, and we gradually got more comfortable with certain credits and relaxed some standards. But it was a successful model. We were securitizing CMO style with different tranches of financing, much like commercial mortgage-backed securities financing, which would
Sure.
be, a AAA, AA, single A, triple B, double B, single B, and an equity piece and an interest-only strip. And that was extremely efficient financing, and it really took the restaurant industry by storm.
Interesting. So, in terms of the restaurant industry as a whole, it's my understanding there's about four major sectors in that business. Could you kind of break down those four sectors and where you see, I guess, some of the opportunity in each sector, or give an example of restaurants within each sector?
Sure, sure. So, I mean, there's the standard, industry jargon for restaurant grouping is QSR, which is quick service restaurants, or what many people call fast food. Then there's casual dining, which is restaurants such as Applebee's, uh, TGIF Fridays, Olive Garden, Red Lobster, and there's a couple hundred concepts like that around the nation that are either super regional or national platforms. And those are casual dining restaurants. They serve alcoholic beverages and they have sit-down table service. Then there are fine dining, which typically people use a distinction of, a tablecloth. And that would include things like Ruth Chris, Arnie Morton's, McCormick and Schmick's, and, chains like that. There is a kind of a new category called fast casual, which is it's in between fast food and casual dining in terms of price point, and also they tend not to serve alcoholic beverages as a high percentage of sales. They do offer them, but as a percentage of sales, they typically around 5, 6, 7%, and those restaurants generally do not have table service. You go up to a counter, put your order in. There are tables in the restaurant, but without service, it allows them to have a little more efficient pricing and price point. And a great example of that would be Chipotle or any of the designer pizza concepts such as Blaze or 800 Degrees or Mod and so forth.
Okay, I've got it. And I appreciate you kind of breaking those down. So, where is the majority of your focus within those segments?
Well, we spend most of our effort on quick service restaurants, fast food, if you will, and casual dining. And of course, we do business in all of the sectors. And we do a fair amount of real estate transactions in both those categories as well. And those are generally good real estate investments. Historically, they've returned very nicely. The restaurants are stable. They tend to stay in the same location for long lease periods, 25, 30, 35 years. There are thousands and thousands of restaurants that were built in the 1960s that are still in the same spot today. It may not be the same building, and it's certainly been remodeled several times, but good locations are hard to find, and they stay good, and they typically make great investments. In some of those legacy spots, you see cap rates today at unbelievably low levels. We've seen them as low as 375, 4, 4.25, up to 5 in major DMAs on the right corner in the center of town, where the volume of the restaurant is right at the high for the national average.
Wow, I'm pretty surprised to hear that they'd be low in that range. So when people are looking to invest in restaurants, when you said like sub 4, sub 5, for example, would that be a standard cap rate for a QSR type of business, or is that closer to the family dining style, or does it matter?
No, actually, that's a good question, Hunter. It's not standard. It's basically the perfect corner in a top 50 DMA, if you will, with
Okay.
the right chain, and obviously the strength of the chain. I mean, if you're looking at a chain restaurant on the lease as opposed to a franchisee, it's going to be a much lower cap. Certainly, Starbucks, McDonald's, Chipotle, Yum Brands. When you look at counterparties like that, you're going to have very, very low cap rates, and generally they're going to be fishing for 1031 exchanges and investors who might have a short time frame and don't mind paying a little more to get something that's fast, easy, safe, and quote like kind unquote.
Sure, that makes sense. Where do you think the majority of the opportunity is right now, given the current state of the restaurant business? I guess give us an idea of where you think we are in terms of the cycle as a whole, and then where the real opportunity is going forward in the next 5 or 10 years, let's say.
Sure. Well, I think we're in a cyclical phase. I mean, we really have tried to beat up the business cycle, try to eliminate it with all the stimulus. Central bank stimulus around the world has, come at unprecedented levels, and I think it's created unprecedented challenges for us in terms of, the amount of debt that's out there, what that means for future financing, future deficit spending, future interest rates. I think that if you look at the ECB and Bank of Japan and the Federal Reserve are all quietly trying to figure out how to shrink balance sheets and how to make interest rates attractive, for investors, and not, get away from the 100% stimulus mode. And that's I think, the big theme right now in where we are in the cycle. If those three central banks continue in the direction of tightening, but not enough to hurt the economy, I think that we have some legs in this economy we can go into, well into next year without any damaging, changes in business activity, or end of the cycle, if you will. However, if they get more aggressive to either support their currency or other issues, I think that we could, this cycle could end, relatively quickly. So, when you look at the Dow 26,000, you look at commodities are all at great levels, but turning up. Interest rates are turning up. There's a lot of headwinds out there, I think, and my thoughts are that we're going to have substantially more whitewater in front of us and behind us in 2019. And this year, I think because of the tax bill, continued hangover of stimulus, I think we should be in pretty good shape. Certainly for the real estate market, leases tend to be longer, and so you tend to have a muted. A recession might hurt somebody who's trying to market a property. It's not going to hurt somebody who owns one with a good rent roll that's going to last for some time.
Totally. And that kind of goes back to those main chains, particularly in those top 50 cities, for example. I read one of your quarterly reports recently that actually showed that some of the same store growth was actually contracting, which I was actually kind of surprised to hear given the massive run up we've had, things like stocks, commodities, et cetera. What are your thoughts on that same store growth? And to kind of parlay about your comment about the recession, which one of those categories in the restaurant business is less prone to those kind of recessionary elements or times in the economy?
Well, that's a great question, Hunter, because, in terms of real estate investors looking for safe places to put money, we always say go big or go home. And certainly if you're with the quick service restaurant chains that, are, 20, 30, 40, in the case of McDonald's, $100 billion enterprises, those have all the staying power you could ask for. And the concepts have large advertising budgets. They have 3, 4, 5, 6, 7, 8,000 stores nationwide, or 15 in the case of, McDonald's, Subway, and Starbucks. And there's safety in numbers. So, I think that the QSR space is the safest. I think that the larger casual dining chains are safe places to put money, and that would include, Darden, that operates Olive Garden and Longhorn and a couple other concepts. Dine Equity, which operates IHOP and Applebee's. These are companies that have resources, that have a history with clientele, a lot of brand strength, panache with customers, and really have the best chance to get into the next generation. And that's really where the risk is in this business is, the next generation is not going to exhibit the same buying patterns as the former generations. And retailers that get that are winners, and retailers that are sort of flat-footed with that are suffering. And I think that, when you think about the restaurant business, looking at it demographically, looking at the 5 generations, generations X, Y, and Z, baby boomers, and the greatest generation, if you can attract millennials, you probably have growing sales. And if you don't have any cachet with millennials, you're probably losing sales, albeit you may raise prices, which masks the loss of traffic. But, P times Q, price times quantities, total revenue. There's a lot of price increases in the last 36 months that have covered up a multitude of sins of, declining traffic in the restaurant business. So, I would say that a lot of the legacy chains, the one that started in the 50s and the 60s, they've really struggled with millennials. And most of their business is coming from the older half of Gen X, and then, of course, baby boomers and the greatest generation. The problem with that clientele is that among baby boomers and the greatest generation, 50,000 people a day are getting a cane or a walker or a wheelchair or a nursing home, or worse yet, a tombstone. And, and then they cease to be customers, or at least frequent ones. And that's a big challenge for the legacy brands, the older brands. And I think if you look at McDonald's, they're the ones that are publicly exhibiting that angst the most in terms of how they're trying to reposition themselves for millennials, because, my 4 kids, they're afraid of the golden arches. They think that, Ronald McDonald looks like a meth lab cook, and they just simply are not going to make that switch until McDonald's really changes its image. And image changing is, sort of a 5-10 year plan, not a 3-year plan.
Totally. And so I have some assumptions about some of the pivots that some of the companies are making. I'm certainly not looking at the data in the way you are. I'm assuming that a lot of these brands are focusing more on health foods. I know that Chipotle has had a lot of success with their pricing model in terms of the service that they're offering. But, from your perspective, what are these brands doing to change their perspective to draw in more millennial clients?
Well, I think that a great example is, Applebee's. Applebee's has always had, a little flow of millennials because, if nothing else, parents are bringing millennials into the restaurants. But Applebee's new CEO, John Cywinski, has done a fabulous job of changing the advertising to make it more millennial friendly, coming up with a bunch of really creative drink specials. And there's all kinds of social media buzz about Applebee's now, and they've really stunned the industry in terms of showing, hey, look, this doesn't have to be a 10-year program. There's some things you can do in the short term. And of course, casual dining has more tools because they've got alcohol and other things they can do, but such as delivery and so forth. But I do think that reaching out to millennials means having a digital presence that's real, having a social media profile that resonates, tolling that, making sure you're constantly checking, your hits and your activity, the number of followers you have and so forth, making sure that you advertise on social media, and really trying to change the perception so that it doesn't look corporate. Millennials don't want to go into a cookie cutter, paper doll cut concept. They want each concept to be somewhat individual. And I think that in the case of Applebee's, they've really tried to, put sports memorabilia from local teams on the wall, have managers and hostesses that are locals, that understand, that know people, and make it more of a neighborhood bar and grill than a corporate one where any restaurant in the United States you walk into is going to be homogeneous and say and do the same thing, which feels corporate, which is not what millennials want.
Wow, that's really interesting. That's so much more detailed than I was expecting in terms of, just being a client of some of these restaurants. So yeah, I definitely appreciate the breakdown there. Where do you think the real opportunity is in this sector? Is it in development? Is it in value add? Is it in some kind of combination of the both or in stabilized? Where do you think that the real favorable risk adjusted returns can be found in the restaurant business?
Well, I think there's really three things. Buying and owning chains that are millennial centric is going to be very profitable. Certainly over the last 10 years, we've seen investors that we've worked with, producing returns, in between 20 and 50%. And and I think that the nice thing about the restaurant business is you can really change your fortunes pretty quickly if you've got the right people, the right business model, and you've got the right approach to your customers. I think on the real estate side, I think there's great money to be made in buying restaurant real estate portfolios, and buy and hold them for a little while, and then breaking them off, one by one, two by two, in the 1031 market. I think there's lots of money to be made there. Certainly, portfolios can be bought, at cap rates between 6 and 9, and certainly broken off into pieces between, for some of the chains as low as 3.5 or so, and 7, depending upon what the concept is. And if you buy something at 6 or 7, and you flip it at 5 or 6, you're going to do well. And I think there are bigger spreads out there depending upon whether you're buying an A, B, or C location, and whether you're in an A, B, or C market. And then, of course, the Z axis of that would be the strength of the concept. And if you're dealing with top 10 and you're able to buy a portfolio in the mid sixes, you can definitely break those off, into the fives without any difficulty. And in some locations have a short franchise agreement, and maybe when it expires, it's on the corner of Broad and Main. That becomes a bank branch, and the property values increases by at least $1 million on top of whatever the rubrics were for the cap rate on the franchise business.
Mm-hmm. That makes sense.
Yeah, so portfolios, and then I think the other thing is, look, you can make good decisions on just buying individual properties. I'm a big believer in looking at the location, even if the cash flow is not interesting. If the property supports itself and it's in the right part of town, it's just a matter of how long your horizon is. If you've got a 10 or 20-year horizon, and you're buying in the central business district of top 50 DMAs, TV signal areas, it's very, very hard to make mistakes there. I think that you just have to be disciplined on purchase price and financing. But I think that those will be good investments with ultimately mid-teen returns. And certainly when you're in a big concept, I think your default risk is very, very low. And so a risk-adjusted return like that, I think, is very attractive vis-a-vis looking at apartments or office or self-storage or industrial.
Sure, sure. So when is part of the strategy then to really take a more on-site management like do you ever identify properties that are incredibly mismanaged, even though they're under the major chain, and say, okay, these guys are really underperforming on NOI. Let's go in, buy the property based on in-place income, and effectuate a more significant management protocol? Or is that not really a strategy that's typically implemented?
Well, for real estate investors that have the ability to do a little more than buy and hold triple net, there's a great opportunity there, and the opportunity would be this: we see a lot of franchises, in say the top 100 concepts, that somebody owns 30 restaurants. Their sales numbers are meaningfully below the national average. They're in a good market. The restaurants aren't in bad shape. They're not in great shape, but they're not in bad shape. And you look at it and you say, well, look, your guy owns 15 fees. If we buy this company and we restore the sales to where they should be and clean up the P&L, we're going to have a lot more sales, and restaurant sales are, in the QSR business, typically around, 8.5% of sales. If we jump sales by, 20%, and, we're valuing these things by 8%, 8.5% rent, we've just significantly enhanced the value of the real estate. And, we can turn around and sell those properties at a significant profit. And that is an opportunity that, people have, exploited. There's not a lot of people running that strategy, but the ones that have done very, very well. We've worked with clients over the years that have done that repeatedly, and that obviously jumps your real estate returns into a, real estate enhanced by a turnaround.
For sure, for sure. In terms of the technology that's coming out, is there any challenges, or how is technology really affecting the restaurant business as a whole?
Well, I think it's going to eventually take a lot of employment out of the restaurants, and that's kind of a shame, because minimum wage employment has served as the training grounds to feed all industries, and help our youth become responsible, understand how to keep a job, get to a job, be attentive to customers, and learn a lot of life skills. But as minimum wage starts to creep up to 12, 14, 15, $16 around the country, it's not going to work within the construct of a QSR typical P&L. And so you're going to see a lot of kiosks, you're going to see a lot of offsite, a lot of delivery, and a lot of real changes. And those are technology driven, but they're certainly expedited by the cost of labor. And I wrote an article in our research journal a couple years ago that was entitled I found the perfect employee, and his name is Kiosk. He doesn't need vacation time. He won't sue you for slip and fall or sexual harassment. He's never late. He doesn't mind working overtime, and so forth and so on. So I do think that is a wave that in 10 years will be probably half of the orders taken in QSR in 10 years will probably be done through digital, whether it's a kiosk or handheld.
What percentage of QSR's expenses are going towards labor?
Most of your QSR businesses are running labor lines in between 26 and 34%, and the average is probably 30. So if a restaurant's doing $1.5 million, they're spending about $450,000 on in-store labor, and then of course there is supervision, which is above the line or below the line, excuse me, and that would be an extra probably $50,000 a store. But direct labor cost in most QSRs is going to be around 30%.
Okay, well that's extremely significant, and you may not have these numbers offhand, but I'm also interested into how much of that labor is minimum wage. Is that extremely common? Is that the majority? I mean, just a ballpark would be beneficial.
Yeah, in the old days it was the bulk of it, and I think nowadays people have figured out that if minimum wage is $9, you're not going to get a good employee for $9. So I think that particularly we deal a lot with the, of course, top 100 concepts. And really a lot with like the top 25. When you're in that top 25, very little, if anybody, is paying minimum wage. They want a better employee. They're going to pay a little more. And so you're going to see people offering, $10.50 to start. And that's just, they want an employee that is a little more responsible, a little better educated. And, typically what they're looking for is, a college student that wants to be, part-time, and is a great face in the customer, super responsible, needs the money, and is not going to quit their job because you didn't give them off Saturday night and they wanted to go see Jay-Z concert or whatever.
Right. So I guess other than the potential risk of the increasing minimum wages, which are taking place over a lot of different cities, what are some of the other challenges that you see the restaurant business facing right now?
Well, I think you got to be careful. If you're a real estate investor, you want to be looking at the P&L of your tenant. It's a little different than multifamily or something that is at the top of the food chain where it's going to happen no matter what. You look at a hedge fund paying $100 a foot for rent on Park Avenue in New York City. The rent numbers sound staggering, especially to those of us that don't live in New York. But when you think about it, it's a rounding error for the hedge fund's P&L. It's not even 1% of revenue, and they just don't even care about rent expense. But when you look at restaurants, a lot of them are paying, 8% of sales. Sometimes if they're not doing well, they start at 8, sales fall, and their rents could be 10 or 11. If you have double-digit rent, you should look carefully at the P&L, and the things you should be paying attention to are labor, food cost, interest rates, in terms of debt service, and controllable costs. And those are ones that you should really take a close look at, just to make sure that your tenant is, minding the store and, not going to get any surprises. And I think increasingly we see landlords asking for financials, not just when they sign the lease, but, certainly the public REITs ask for annual audits for portfolios and reviewed statements for, small clusters of stores. And now we see them asking for, do you mind just giving us quarterly sales? So I do think that there is an intensification of, paying attention to the P&L, and the things to look for, again, are labor, cost of goods sold, the interest cost, and what they call controllables, which is a whole laundry list of, items in the P&L that get wrapped into a single line.
So I have got to ask a question that I think almost every industry is constantly asking, which is what's going on with Amazon? How does this have the potential to affect the business? I know that when Whole Foods was purchased by Amazon, for example, there must have been some kind of reaction. What are your thoughts on what Amazon is doing, particularly as it relates to the restaurant business?
Sure. Well, Amazon would love to get into the delivery business. And I think that when you look at what technology is doing to restaurants, it's really inviting restaurants to share their margin with delivery. The notion of having somebody sitting on their couch at home watching Netflix, picking up their cell phone and putting an order in is a very powerful trend. And I think that Amazon, by buying Whole Foods, does have a leg into creating prepared food in those stores and delivering it, and creating prepared food that is markedly better than in terms of quality and presentation and healthiness, and that's a big threat to the business. I think if you look at some of the byproducts of this, if you're a real estate investor in a Whole Food property and Amazon just bought them, you've probably seen a significant increase in the credit quality of your lease, and that will transfer itself to property valuation. I do believe that the Amazon is working on strategic plans to see how home delivery food service can work, and where what price point they'll establish themselves at, because they do have a little more expensive raw materials, and their price point's going to be higher. And I think that they will methodically roll themselves out, but there will not be a lot of passage of time before Amazon really puts its footprint on how to efficiently deliver to the home. And I think the other thing on the other side of Amazon's ambitions is I think they'll want to control delivery and transportation up and down the food chain, depending upon what the Department of Justice will let them get away with. So I think if they could buy FedEx, they do it in a nanosecond. And I think that if they could buy Uber or any of the 15 or 20 delivery services, they would do that as well. So it'll be interesting to see with their capital and their political influence, what they're able to pull off. But with the resources they have, I would not bet against them.
How do you anticipate the Affordable Care Act having an impact on the restaurant business as a whole, and which sectors do you think that will most affect?
Well, I mean, I think the recent tax bill, took away the obligatory, payment side of that, and I think that's a big change. But what's happened with most restaurant companies that were in the position to have to offer health care to all employees, did so judiciously, and then just simply the copay from copay is the wrong term, but the percentage covered by the employer is pretty Spartan compared to what it was in the old days. In the old days, they would cover managers because crew level in the restaurant business is mostly transient jobs that last on average about 6 months. And managers and so forth had the opportunity to participate, and they would have some payment scheme that would be with the employer paying anywhere from 25 to 75% of the monthly bill, depending upon who it was. I pay 75% for my employees, and the restaurants are all over the spectrum.
Right.
But I do think that the restaurant industry has adroitly handled the Affordable Care Act, and I think that now that the mandatory payment provisions are out, it's not really it's no longer the big issue it was when they were debating the legislation.
Okay, that makes sense. And is there any other legislative actions that you're currently seeing coming down the pipeline that you think could have a significant impact on the restaurant business or the economy overall?
Well, I do think that we're going in the right direction with regulation. There's always government always has the impossible challenge of trying to balance over-regulation or not enough regulation. Clearly, we have to protect the environment. Clearly, we have to, look out for worker safety, public safety. Clearly, we have to have free markets, but we have to have balance so there's no predatory pricing or abusive policies. But we need to do that in a way that makes us competitive around the globe. And it's a challenge because there are some countries that, do not have the regulatory bootstraps we have. And so it's a real challenge. The left and right fight about this all the time. But, we need the right balance. I do think that the pendulum swung a little too far, and we have, loosened some things up. I like to see that, but I like to also see sustainable policy that's prudent, that doesn't harm future generations, and that's the challenge that Congress has got to make sure they strike a good balance. The biggest risks, of course, are interest rate, minimum wage legislation. Any kind of development constraints. Clearly, if you look at the amount of paperwork that it takes to build a quick service restaurant in LA County versus, say, Birmingham, Alabama, there's a big difference. And I don't pretend to have all the answers, but somewhere in the middle of the two of those is probably the right answer. And we frequently see people spending a year and a half, sometimes 2 years before they can break ground. And I think that is a bit of a disincentive toward development and growth.
Are there any segments of the restaurant business that you're completely staying away from that you think that it's, the timing is not right for whatever reason? Are there any segments that are really giving you pause or fear in that sector?
Well, I think there's always, migration of taste and preferences. There's concepts that are, have their halcyon days are behind them, and you always got to be, on the lookout for that. There's no sectors that we avoid, but we clearly are very picky about the concepts that we spend time with because, we really want to be centered in concepts that have great sustainability, great future growth prospects, and because that makes it easier to make, business and capital markets and capital structure and real estate decisions.
Awesome. Well, one more question, Kevin. Do you have any advice for young real estate investors, entrepreneurs that really are looking to streamline their career to avoid major mistakes, time-wasting tasks, stuff like that? Or any takeaways that you can give based on your success in this space?
Well, I think, for career advice to somebody that's in an organization, a large organization, I think you really need to, continue your education. With graduate school, I think outside reading is critical. I think that, getting really good assessments about character and personality development, make sure that you are at the top of the list of an HR department in one of these large organizations. I think on the other side, on the entrepreneurial side, as a an investor that's buying one or two locations, and hopefully one day wanting to have a lot. I think you've got to establish a good reputation. You've got to have good quantitative skills. You've got to have good banking relationships. You've got to have an eye for detail, and really make sound fundamental decisions that will set the stage for good business or real estate holdings down the road.
Awesome. Well, again, Kevin, I really appreciate you coming on. Definitely talked about a lot of different topics. So again, thank you so much.
Thank you, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.